Welcome to today's webinar on carbon accounting in the finance industry. Before we get started, I wanted to take a moment to set intentions for this webinar. We really believe that the financial industry is super important for three reasons. The first is that the financial industry underpins all sorts of businesses around the world. Financial organizations can boost the next big startup, they can provide life-saving insurance, or they could help someone just build life savings. It's really, really impactful in everybody's daily life. The second reason is because the financial industry has the power to make really impactful investment decisions. They can shift money from legacy polluting industries towards future sustainable businesses and technology. And so these firms are the ones that have a huge influence to help the world reach net zero. And last but not least, we really believe that Normative's unique approach to carbon calculations is particularly well suited for this industry. Our approach incorporates accurate and comprehensive carbon reporting across all the greenhouse gas scopes, especially the complexities of Scope 3 and value chain engagement. It's part of our mission to help businesses like yours uncover the carbon data that you need to transition to a net zero economy. So let's get started. Here's a quick agenda for today. My name is Taylor, and I'm a product marketer at Normative. As of this week, I've been at Normative for a year, so I am celebrating that milestone. I'm going to be the host, and I'm super excited to welcome a few of my colleagues and a special guest. Next, I will pass the mic to my colleague, Dr. Alexander Schmidt, who will share an overview of where this industry is heading. He'll talk about why carbon accounting is so important for finance, the most relevant regulations, and other challenges that are facing the industry. Then we'll go to Riyad Wakim, who will share a more detailed look into what it takes for a financial institution to complete effective carbon accounting. Riyad is a climate strategy lead at Normative with a specialization for the finance industry. And finally, I am so happy to welcome our special guest, Peter Hirsch from 2150. Peter will share a look inside his work and explain how 2150 uses carbon calculations to make smart decisions about the future. Peter and I will do a short Q&A at the end so I can ask him a few of my favorite questions. And I will let each of our speakers introduce themselves during their sessions. Just some housekeeping before we dive in. We really want to respect your time, so we're going to aim for a 45-minute duration. The webinar will also be recorded, so there's no need to take frantic notes. You will get a recording in your inbox in the next few days. Also, please do submit questions using the question and answer feature in Livestorm. We're not going to do a live Q&A at the end of the agenda because we really want to get you answers that are accurate and detailed. So what we will do is we will collect your questions and we will write back with the right answers for you. And last but not least, before I forget, we are always trying to improve the content that we produce. So at the very end of the webinar, you will be redirected to a short survey. It will only take about a minute to complete this survey, but that feedback is what will help us make our future webinars even stronger and more meaningful for your work. So now the fun stuff. I get to introduce you to Normative. At Normative, our mission is to make known and reduce the sustainability impact of all economic activities on the planet. And we approach this challenge from many angles. Our co-founder, Christian, was a researcher at the University of Oxford and maintains a lot of connections to leading universities and the UN. We also really work hard to foster our relationships with groups like the EU and the UN. We are the co-founder of the SME Climate Hub. We partner with innovative tech companies like Google, who supported the development of the Business Carbon Calculator. The BCC is our free carbon accounting tool for small businesses. And much of our team comes from leading tech companies like Peakon, Spotify, and SAP. So at Normative, we deliver the world's most accurate emissions calculations. And that's important because businesses like yours need accurate carbon accounting in order to identify opportunities for carbon reduction, and then to verify that those reductions have had the impact that you intended them to have. But how do we deliver on that huge promise of accurate and verifiable carbon calculations? When we serve the finance industry, we do so with comprehensive coverage, powered by intelligent automation, and all of it is relying on a foundation of scientific integrity to ensure that our work is aligned with best practices and vetted by professionals. In the finance industry, we know that investment portfolios are huge and cover many industries. And so that's why automation is so essential, so that the process of gathering primary data is straightforward, fast, and user-friendly. We then use a deep database of over 9,000 emissions factors and 26,000 categorizations to ensure that we are matching each business activity with the appropriate emissions data. That means however your investment portfolio looks, we can ensure coverage and accuracy. And most importantly, everything we do is built on a foundation of scientific integrity. We always incorporate the newest scientific research into our calculations to ensure they are compliant and trustworthy for both marketing initiatives, strategic planning, and more. I am now thrilled to pass the mic to my colleague, Dr. Alexander Schmidt, who will share more about where this industry is heading.
Thank you so much, Taylor, for this nice overview introduction. I hope everyone can hear me well and is excited to get started with our content of the main part of this webinar. As Taylor already said, so my name is Alex. I'm heading our Science and Climate Research Department with the Normative. And again, Taylor already touched upon our emphasis on scientific integrity and scientific research insights. And that's exactly what I'm here for at Normative. So to kick us off, I thought I'd just give us a bit of context for this whole webinar before my colleague Riyad and also Peter then will share really some more kind of like user stories, etc. So what I would like to start off with you now is looking at the financial industry and its role in the transition to net zero. We already heard a bit in the introduction that we are relying on a lot of financing and capital to actually successfully make the transition to net zero possible. And of course, finance here operates across global value chains, pretty much along every intersection of those global value chains to inject capital. We do also know that currently we have a huge funding gap of around $90 trillion that needs to be filled in order to make the transition to net zero actually successful. At the same time, it is not just about putting money somewhere, it is about effectively allocating this money into industries, into transition paths that actually would get us to net zero. And that's a huge challenge for which finance, the financial industry, is of course crucial. Now, this is probably a view that some of you or most of you might have already heard. What I also want to give you as a bit of an inspiration here, as a flip side, look at how the net zero transition is also key for finance, because you see increasingly the attention on carbon emissions being operational risks in most companies' value chains, but then for finance also in their portfolios. The more investments they have in these assets that might ultimately become stranded assets, the more risky, of course, their whole business and their whole portfolio could be perceived as. At the same time, you also see more and more regulations coming in, especially in the financial services industry. So companies of the sector need to be aware and need to navigate that space very well in order to successfully survive, if you want, or even thrive in a net zero transition. But it is not all just sticks. There are also a lot of carrots out there because consumers, but also investors, they all are looking for supporting with their choices, with their money, businesses, and of course, financial institutions that are actually making progress towards net zero. Now, with that being said, let us have a look at the current challenges as they present themselves for companies in the financial sector. The biggest one, probably most obvious one also, is the general question of how to and where to. How to meaning for me, how do we actually start to measure these emissions? I touched upon it already before. Financed emissions or emissions in portfolios of financial institutions, financial service providers are not as tangible, if you want, as they are for companies with heavily physical value chains or supply chains. They're really in the investments. So how do we actually do this correctly? And I can already say Riyad is going to have a lot to share there with you in a minute. But right now, a lot of companies are struggling and financial institutions do not know exactly where to start here. Secondly, it's important to also put on the table and address the question of where to, because we do see that apparently companies, financial institutions, banks are not well aligned yet as to where they should be going. I just picked two stories here for illustration. We saw that the GLS Bank has left the Glasgow Financial Alliance for Net Zero, one of the biggest and most important alliances around net zero transition in finance. And they have left this alliance because they saw that many of the peers of the G funds, as it's called, they are not willing to or have not followed through with their commitment to actually reduce their emissions and divest from fossil fuels as would be mandated for a credible net zero path. At the same time, we see banks being sued over the continued investment into fossil fuels. So apparently there is some misalignment between what should be on a net zero buffet, if you want, like net zero pathway, and current actions and decisions of companies that are not yet aligned with this transition. Secondly, not a secret, and most industries are in the same boat here, data availability. Data is so crucial to make meaningful progress towards net zero. Now, while it is true for each and every industry, for finance, once more, we have to highlight that their emissions are not just, quote unquote, in physical supply chains. They actually sit in investments, and getting data on these emissions, these so-called Scope 3 emissions, then for finance, this is often even more difficult for companies, for banks. And we see this in a recent study that has been conducted for the UK, where we have here highlighted in this coral color portfolios that are aligned with a below 2-degree global warming scenario, and in the grayish color, misaligned portfolios. Now, while we see that corporates are making steadily progress to align more and more of the portfolios with a below 2-degree global warming scenario, many asset managers and banks are not there yet, which is probably one of the outcomes of having not the right data available to actually make meaningful and aligned decisions towards net zero. Now, last but not least, we see a big struggle in finance for comparability. How do I actually know, and this comes back to my previous point about allocating capital efficiently or effectively, how do I know if my investment, if my portfolio is actually on track? So what is the right data point, and how do I compare claims of different companies made around their progress towards net zero meaningfully and accurately? And that is, of course, an accumulation, if you want, of other points, such as the data availability and the how to measure to begin with. So these are huge struggles that companies in the financial services are right now facing and they have to deal with. How can we help them to navigate this space a bit more nimbly and a bit more successful? I have picked out a few of the regulations and frameworks I want to discuss, and then, of course, later on you hear more from Riyad and Peter around actual, hands-on examples of how this is being done in software and in real life, if you want. So let us start by having a look at accounting and disclosure frameworks. And just bear with me here, because I know it can be a bit overwhelming. I put quite some logos here. I will not comprehensively go into each and every framework here, just because, especially in finance, they are quite vast and complex. But I can only encourage you, as Taylor already said, to reach out to us with your questions, because we get it that it's a lot of content to digest, of course. But if you want to focus really on the essentials, accounting, it's important for finance to be aware of the Partnership for Carbon Accounting financials. That is, if you want a more specific appendix to the gold standard of carbon accounting, which is the Greenhouse Gas Protocol. And it especially details the category 15 of Scope 3, so meaning your finance emissions, how to calculate those finance emissions accurately. So PCAF should be the answer to your how to measure emissions on a very broad level. Nextly, if you have accounted, you want, of course, disclose this. So the frameworks to follow here and to be aware of are, for example, the Task Force on Climate-Related Financial Disclosures, the TCFD, that really has set out to the mission to empower stakeholders to take carbon information into their decision process. And they directly have a link to PCAF through recommending that as a method. but they are also already enshrined in UK law. So that is a good framework to start your disclosure on. It is also encouraging that the IFRS, the International Financial Reporting Standards, which are focused on the global level on financial accounting, now also moves more and more into carbon accounting, which again, we can only encourage. So the International Sustainability Standards Board is right now reviewing the main proposals that they will set out as disclosure guidance for finance or for carbon accounting in the financial industry, which is very an encouraging trend to see. Moving from accounting and disclosures, then to regulations, because that will of course be on most of your minds probably. How do I how can I make sure my operations are compliant? Now in the EU, there's an upcoming change towards a more rigorous reporting requirement in 2024 onwards. That is the Corporate Sustainability Reporting Directive, or CSRD. Under the CSRD, there will be roughly 50,000 more companies in the EU being mandated to disclose their emissions. And very importantly, it's in the EU. It is not just EU companies. So also if you have subsidiaries, for example, in the EU, this will affect your business or your financial service institution there. Currently, the standards are still being finalized by the European Financial Reporting Advisory Group, but the timeline right now says 2024 onwards, companies need to start to comply, and that includes, of course, to a big chunk, finance as well. In the UK, we already have 12,000 large businesses being affected by the streamlined energy and carbon reporting, the SECR. And recently there have been updates which can be labeled as more scrutiny imposed on greenwashing by the Sustainable Disclosure Requirements, the UK's SDR, under which such claims need to be verified more rigorously or more transparently than before. So we see more and more push towards regulations. You will see on the left-hand side, I also put the US here with the Security Exchange Commission's proposal. However, it's not final yet, so I was hesitant to put it here as a definite statement, but be aware that there are also more and more regulations probably in line with what we see in the EU and the UK towards more disclosure across the scope, meaning also your financed emissions then. So what does this then leave us with? I mean, I've mentioned a lot of for some of you probably scary facts around, misalignment currently and upcoming regulations and scrutiny. Well, it is a fact that there are a lot of risks out there that have to be navigated well by the financial industry. Given that finance emissions are on average 700 times higher than the own emissions generated by your own operations and finance, these emissions are too big to ignore, so you have to address them. You have to address them in due time, because next year onwards in the EU, there's going to be increased scrutiny on these Scope 3 emissions of the financial services industry. But once more, there are also a lot of opportunities here to be at the forefront of a net zero transition by effectively allocating your capital, but also to attract more consumers, more investors, more stakeholders who are willing and are happy to pay a premium on that. And with this, I will close my part and will hand over to my colleague Riyad for some more insights into our product and how we tackle the finance emissions. Riyad, over to you.
Yes, thank you, Alex. And hello, everyone. And my name is Riyad Wakim, as previously introduced. I'm a climate strategy team lead at Normative, focused on the financial sector. My work involves helping our clients basically in measuring, managing, reporting, and reducing their corporate carbon footprint. In the following slides, I will be complementing what Dr. Alex started with, and that is solutions for the financial sector in terms of carbon accounting and how we can help at Normative. To set the grounds and to just start off with the definition of the category in question here, and that is Scope 3 Category 15 as per the Greenhouse Gas Protocol. Scope 3 Category 15 in essence are basically all emissions associated with the investments or finances that a financial institution undertakes, whether a financial institution or an asset management company. In its value chain, emissions associated with these activities have to be reported in Scope 3 Category 15. A bit of background: the Greenhouse Gas Protocol was first published in 2001 and revised in 2004, and it serves as the gold standard, as previously also introduced, in terms of greenhouse gas accounting for corporations. Scope 3 Category 15 in specific, originally when it was first published, did not really have a very comprehensive guidance on calculation methodologies that allowed for the calculation of different asset classes and different types of financing activities. This lack of depth caused financial institutions historically to use different approaches of accounting methodologies and to measure financed emissions, and basically opted in different reporting metrics that were not very comparable. This lack of standardization originally hampered with transparency and accountability in the finance sector. Therefore, in 2019, and that's where banks, investors, and fund managers, so basically market players, partnered to create what is known as the Partnership for Carbon Accounting Financials, PCAF. PCAF is an annex, basically, of Scope 3 Category 15 that increased the scope of calculation methodologies for a lot of different asset classes. The commitment of the standard is basically to enhance the measurement and disclose absolute greenhouse gas emissions of financial institutions' portfolios, known as financed emissions. And this industry-led initiative has expanded quite rapidly worldwide, and is considered to be today the one and only kind of annex to the Greenhouse Gas Protocol when it comes to Scope 3 Category 15 financed emissions. And the aim of PCAF is to standardize the way financial institutions measure and disclose financed emissions, and to increase the number of institutions committing to disclosing these emissions and standardizing the process along the way. With that said, and based on the accounting standard, how can you start? How can every financial institution today start in accounting, measuring, and managing their financed emissions? Carbon accounting and finance, in essence, can be divided into 4 key steps, starting with data collection, calculation of emissions, followed by carbon insights, and lastly, activating those insights and taking action. In the following slides, I will be going through each step, what it entails, and highlighting the challenges and how we can support at Normative. In terms of data collection, and that is the first step in a carbon accounting journey for financed emissions. The reason for why this was built in our product at Normative is based on the commitment that we have on providing a comprehensive coverage of our customers' emissions across all scopes. As every single customer might organize and keep data and think of emissions in different ways, we need to ensure that Normative can intake, reveal emission insights in a very flexible way. Nonetheless, we also know that emissions data is scarce, and institutions face many challenges on obtaining accurate data on financed emissions. And lastly, carbon accounting standards, as noted earlier, are continuously under reviews and updates. And in light of upcoming legislations highlighted by Dr. Alex previously, and market best practices, data collection needs, in essence, to be regularly updated and reviewed. Now, how our product serves the users. In terms of data collection, we ensure that our product allows for various data inputs that accommodate different data availability depending on what kind of data is available, and would in return allow the organizations to measure their footprint. Data can be as accurate as providing and having audited emissions of investees, or to providing just basic financial figures of investees to allow for estimations of emissions. Now, allowing customers to organize their data and oversee their emissions information in ways that are more closely aligned with the existing reporting models and organizational structures. And in the left-hand side, you can see a quick screenshot of the product whereby import of data is basically streamlined in a way that just feeds into the product to take us to the next step. And the next step here being calculation, and that's when our carbon accounting engine runs the calculation. Now, why we built the calculation model, again, as per the PCAF standard for financed emissions, essentially to ensure that financial institutions report on emissions, again, with a comprehensive coverage of their Scope 3, where GHG impact or greenhouse gas impact of all financing activities are assessed accurately and measured. Now, the other reason or the other focus point here is mapping the available data to the best and most updated emission factors. Emission factors that are built on many different variables, such as countries, regions, and others. And this has to be continuously up to date. And that is something that is key to ensure accurate carbon accounting. How this serves our users is that our engine during the calculation phase maps the best available data to thousands of emission factors, as earlier introduced by Taylor as well. That simply allows emission factors and sources to be mapped to different regions, countries, sectors, activities, and other economic variables. Now, ensuring accuracy at all times, the calculation engine is regularly updated to accommodate for greenhouse gas accounting updates and methodologies at all times, which ensures alignment to standards such as PCAF and the Greenhouse Gas Protocol, and also, more importantly, to upcoming legislations and disclosure standards. In terms of the next step after this, so once data is collected and emissions are calculated, we move into our third step, and that is data analysis. The importance of data analysis and why and the need behind it when it comes to financed emissions is that financed emissions data can be is an extensive task. Understanding it is an extensive task, one that is usually paired with complex variables on data accuracy, intensity, and risk. Our customers want to follow, review, compare, and define their performance over time, and be able to set targets that are data-driven. There is a growing need as well of simple, actionable, and data-driven insights. We know that the requirement of reporting and certification will only become more and more relevant as we go as well. And how normative here can serve its users is firstly by providing the insights overview that allow the users to dissect and filter their financed emissions into different scopes, sectors, geographies, and data accuracy scores as per the PCAF standards. Intensity metrics, such intensity metrics, in essence, really allow companies to benchmark while reinforcing a comprehensive coverage of their footprint, helping them easily access an established measurement to action and report on. Nonetheless, it also allows for identification of emission hotspots, or basically the quick wins that an organization can undertake, and certain low-hanging fruits in your Scope 3 category 15 that you can attain in the short term. As shown also on the left image from our product, Data Insights represent a comprehensive overview of financed emissions, allowing users to take data-driven action and set realistic targets. Now, last but not least, and that is the fourth step in the accounting journey of finance emissions, and that is activating those insights. Once you have calculated your carbon baseline, all the data that you need, not only to make informed decisions on your sustainability journey, but to also verify the impact of those decisions with repeatable and scalable reporting. There are many, many things you can do from here. You can set realistic reduction targets, design sustainability initiatives, and eventually invest in carbon removal projects. Beside such low-hanging fruits, there are more opportunities with financial institutions to gain from the insights of their financed emissions. Of course, financial institutions want to make investments based on concrete data that is verifiable and a trend that is understandable. And as carbon legislation will impact all businesses in the near future, it's increasingly relevant for firms to evaluate the carbon metrics and the emissions reduction progress of potential investments to minimize the climate risk of their portfolios. Moreover, carbon insights in a portfolio of an organization can also be used to design effective and green financial products. For example, linking interest rate or financial returns to a company's progress on net zero. Lastly, it is also important to mention, as previously quite mentioned a few times, financial institutions can have a direct influence on climate change, because simply put, they are the ones that are able to direct capital towards businesses that are having a positive impact. With that said, I hope that I have given you an overview of the carbon accounting journey of financed emissions. And now I hand over to our guest, Peter.
Great, thank you so much. I loved the ending and talking about financing companies that are ultimately having a positive impact, because that's what I'm here to talk about. So I'm Peter. I'm with a venture capital fund called 2150. We're based between London and Copenhagen, and I'm going to talk to you about carbon accounting in venture capital and how we go about it within our business and why we really see carbon accounting as an essential part of our impact monitoring and strategy. So next slide. When we think about how we approach funding as a venture capital fund, 2150 built our thesis around this idea of cities, and that cities are where the climate battle will largely be won and lost. So this is what the UN Secretary General Antonio Guterres said. And this really is sort of like a mission that we have structured our investment strategy around, and that cities are the drivers of climate change in many ways. They're the areas most acutely exposed to climate risks. And essentially, if we're going to solve this climate crisis, it's going to be in urban areas. So when we invest as a fund, we try to find ways to approach urban sustainability challenges through the startups that we ultimately support and how they're helping to address those challenges. Now, a little bit of a deeper dive into cities and why they matter. So cities represent 70% of greenhouse gas emissions globally, about 75% of final energy consumption. I won't go through all these statistics, but essentially they are the drivers of resource and energy use in the world. They also generate the majority of GDP, and these impacts are only going to increase between now and 2050 when we need to reach the goals of the Paris Agreement. So the population of cities is going to increase significantly. The share of land that cities take up is going to increase by about 50%, even though it takes up only about 1.5% of global land area right now. I think quite astonishing is to think about is that 75% of the built area by 2050 has not been constructed today. Essentially, everything that we know as our cities, we're going to build 75% more of that in the next 30 years. So when you think about what needs to happen between now and then to reshape the way that we build, we operate, we plan our transportation systems, there's a lot of potential that we see as a venture capital fund to be able to, I guess, capitalize in some ways on what we see as the largest mobilization of capital in human history, potentially. That if we're actually going to reach the goals of the Paris Agreement, truly decarbonize our urban environments and help them become resilient, that means that there's going to have to be investment opportunities within that. And that's what we try to seek out as a fund, to be able to scale up those solutions and ultimately drive change through our capital. Now, when we look at where we invest, this is just a quick overview of 2150 before I dive into the carbon accounting side. We're a global fund based, again, between London and Copenhagen, but started in 2021. Initial fund size of 270 million. And right now we have 15 portfolio companies, as you can see, spread across the world, investing in things like hyper-efficient windows, which is Luxwall on the left, to batteries that replace diesel generators for construction sites, that's Amped all the way on the right. And then I think you might also notice a name that you recognize here. There's Normative, which we see as an essential part of being able to decarbonize our world, because you can't manage what you cannot measure, right? And so at the bottom of here, you can also sort of see some of the partners that we've gone into financing with, some names like Breakthrough Energy, which you might be familiar with. Now, when we think about tracking our impact and sort of where carbon accounting fits into this, so my role specifically within the group as the head of sustainability, I need to think about this from the positive lens and also from the adverse lens. That there's the impact that we want to have with our capital, which is ultimately reductions of greenhouse gas emissions and other environmental impacts related to adaptation and biodiversity. And then there's the adverse impacts, which is essentially our contributions to climate change through greenhouse gas emissions. And so when we track our impact, we look at these emissions reductions, energy savings, resource savings. We also look at the greenhouse gas emissions from our own corporate activities. So just sort of what the fund does from our day-to-day business, what our portfolio companies are ultimately emitting. So this is in their operations, whether they have an industrial facility or they just have offices. Those are our financed emissions and exactly by the scope of what was described in the previous presentations. And then we also look into ESG oversight and some needs under the Sustainable Finance Disclosure Regulations, as was described again earlier in this webinar. But what I see is that we want to be able to grow this positive impact, and we also want to be able to manage these adverse impacts. And carbon accounting is sort of the thing that links those two together, where we're going to be able to see where the positive side of our capital ultimately is growing, and also ways they're going to be able to reduce those adverse impacts. Now, when we look at that sort of dichotomy again in terms of this adverse and positive side of things, we need to understand why do we actually need to track these emissions. So most obviously is from a regulatory lens. We are an Article 9 fund, which means under SFDR, everything that we invest in has to have a sustainable outcome and a clear rationale for how it contributes to an environmental end. Here, from a regulatory lens, also, we have to track our greenhouse gas emissions, both of our own corporate emissions and our finance emissions, and report that to the regulators. That's a sort of simple need and what normative helps us to do. On a more sort of adverse side, though, we also have an internal carbon tax that we apply to our scope 1, 2, and 3 emissions. And we use the calculation derived through normative and also just as a carbon accounting engine to be able to understand exactly how much is that carbon tax going to cost this year? What's the full volume of our greenhouse gas emissions? And how can we have a clear justification for why we are taxing ourselves that much internally? Then looking onto the positive side of things in terms of improving impact and target setting, ultimately what we're trying to do is foster low carbon companies, ones that are really driving change. And what normative helps to pull out, and also what carbon accounting in general helps to pull out, is pinpointing exactly where are there opportunities for decarbonization within a company's operations. So this is called the low-hanging fruit in many ways. And then there are also major sources of emissions where they might be unusually exposed to a certain material, a certain energy source, something where it's very clear that this is a driver of their adverse impact and something that we might be able to work with the company on to be able to switch their business model or their product a bit to not be as exposed to that. And then on target setting, as all companies are increasingly doing, we seek to support our companies to develop 2050 targets for net zero. And in order to do that, you need to understand where your emissions come from. And so here, normative is essential in helping to provide that baseline and then starting to chart out a path for ultimately what net zero look like over the coming years. Now, I want to hone in on one example specifically. So sort of how would this actually, what would this look like in practice, right? So when we look at improving impact, as before, I said that you can find these low-hanging fruits that come out of this carbon accounting. What we've been able to do in the past year, specifically at 2150, is work with our portfolio companies based off of the initial normative analysis to be able to understand sort of where their major sources of emissions are and where there's low-hanging fruit. One of the most productive areas that we found so far is being able to switch or address their scope 2 emissions, which is emissions largely from electricity, to be able to look at renewable tariffs or switching to renewable energy, which will ultimately address those scope 2 emissions. Understanding that they might have a large exposure to those electricity prices and both the carbon embedded within it, these companies are much more receptive after seeing that data to then go out into the market and seek what it might actually cost and what it would mean to switch to a renewable tariff or buy renewable energy credits. Now, I think just as a last point to make, and then we can open it up for questions with Taylor. I think when I'm looking at sort of where VC and private equity is moving in terms of carbon accounting, there's a few areas that I think that it's important to highlight. First, that SFDR and CSRD, as was mentioned before, are coming both in terms of their current reporting needs as well as their future reporting needs. What we see is that essentially you need to be regulation ready. This is both for funds and for corporates, as the coverage of these policies is quite broad. And greenhouse gas reporting is really an essential part of that. What we also are seeing in sort of like being on the forefront of a sort of an impact-oriented fund is that carbon accounting and emissions reporting and then net zero targets are really becoming sort of the evolving best practice, where effective funds and those funds that are sort of seeing the like where the momentum is moving, that essentially this industry is starting to build towards this standardized practice of being able to report on your emissions as well as fostering these transitions to net zero. This sort of leads into the next point on the carbon management, where transition plans are now going to be a part of typical disclosures in CSRD and TCFD reporting, and even in SEC discussions. They're talking about having a publicly disclosed form of transition planning, where essentially say, what's it going to look like as we actually get towards net zero over the coming decades? And this is only possible once you actually have carbon accounting in place and you understand where you can pinpoint and target your specific decarbonization initiatives. And last, and a bit of a shameless plug for 2150 as well. We do impact reporting on an annual basis, which we heavily integrate our carbon accounting into. Last year's impact report, which you can see a small thumbnail of, is online on our website. Normative is currently helping us out to be able to develop the insights for this year's impact report, which will come out in about mid-May. But really, sort of what's becoming sort of standard practice for, again, impact-oriented funds is to put out this type of annual publication to show, essentially, are you achieving the mission that you've set out to do? So with that, I think, Taylor, there's a few questions that we can go through.
Yeah, thank you so much, Peter. Super, super cool stuff. I have a few favorite questions to ask companies that are doing this process. I think I'll do two. We are running a bit tight on time, but the two that I love the most, what has been most surprising for you during this calculation process?
Yeah, so I think in terms of surprises, what we've seen with our portfolio companies is an unusual willingness to take this on. Like, I guess we're an impact-oriented fund, right? But what we have found both encouraging and surprising is the value that our companies see in actually getting this insight into their operations from a non-financial lens. This is particularly for sort of like companies exposed to the physical economy, sort of like the instead of just service-based or sort of like SaaS businesses. They're the ones that use this data to be able to build in insights for where they might be able to create efficiencies within their own business. And that's been really, really encouraging to see that there's enthusiasm from their part to take this on. They're not seeing this as sort of just a reporting need from an impact investor that's asking for all this information from them, but is really, truly a value add to how they're going to be able to manage their business.
That's super positive. So second one, real quick, what advice would you give to someone who might be in your shoes? Let's say in a VC firm, a PE firm, who's just beginning carbon accounting. What advice would you give that person who's just getting started?
Yeah, so I think it starts as a conversation with like both internally and then with your investments. As our fund sort of started out as a, like sort of impact oriented and climate oriented from day one, we knew sort of how we would go about this. But I think for funds that maybe already have investments in operation and sort of like a legacy of operating and sort of how they go about it, it's about sort of building your practice out to understanding how are we going to sort of build in these new tools as we advance over time. So rather than just saying from day one, this is how we're going to do it, it's about sort of charting out a pathway to bring on the appropriate companies, maybe the appropriate people within your business to sort of build ultimately the practice along with you, because this isn't just going to be a light switch that turns on. It's about really sort of integrating it across processes, people, and then within your companies as well.
That is so awesome. Thank you so much, Peter. We are at time. This was a great webinar. Just to wrap up, we firmly believe this. It's never too late or too early to start carbon accounting. If there was something in our webinar that really piqued your interest today, I think we can put up a button to the, yeah, here it is. You can book a demo with one of our climate experts. So if you want to learn more, click this link, join us on our website. And we are more than happy to talk to you about some of these pressing challenges in the financial industry. And that's it. That is it. We're going to wrap up. I would express a huge amount of gratitude for our speakers today, Peter, Alex, and Riyadh. Thank you for coming. Thank you for everyone who was listening in from all around the world. If you asked a question, we got some great questions. We will collect those, as I said, and write you a good, accurate response. Accuracy is one of our core values, and that will be in your inbox, and the recording will be in your inbox as well. So thanks again for joining us. Hope to see you at Normative's next webinar.